Yo, what's going on, guys? Welcome back to the channel. Welcome back to another video. In today's video, we're going to break down, in hindsight, a trade that you could have taken on GameStop, taking advantage of the high implied volatility coming into earnings. Now, if you guys are familiar with IV Crush, with the expected move, then this video will probably be easy to understand. But after we get past the intro, I'll do a quick recap on those two terminologies so that you guys that don't understand will sort of know what I'm going to be talking about in this video. We're going to do this in hindsight. Now, I know you might say in the comments, why didn't you take this trade? This is all in hindsight, and I understand that. But the reason I'm making this video is because it's a good learning lesson. It's a good way to see how you could play earnings on stocks that have very high implied volatility and very high expected moves. So I hope you guys enjoyed this one. Before we get into it, make sure to press that like button for me, subscribe to the channel for some future videos, and make sure to press that bell notification so you know every single time that I post on the channel. All right, guys, so in the next 30 seconds, I'm quickly going to explain expected move and how that plays into implied volatility crush. When you're coming into earnings, a stock has an expected move. That's the amount that the stock is expected to move either to the upside or the downside. Let's say the expected move on a stock is $20. That means after earnings, it's expected to go in between $20 to the upside and $20 to the downside, which is a $40 range, right? So if a stock moves up $10 and you have call options, then your calls will actually depreciate in value even though the stock went up. That is called implied volatility crush. It works the same to the downside. If you have a put option and the expected move is $20 and it has to move down $20 for puts to appreciate, and it only moves down $5 a share, your put options, even though the stock went down, will depreciate in value due to implied volatility crush. It's very important to understand these two concepts coming into earnings, especially if you are playing option contracts to the upside or the downside. So now that we have that out of the way, let's go ahead and get into this play that I found. It's an Iron Condor, and I'll make sure to explain all of this in the video in just a second. All right, guys, so I have GameStop pulled up. This is the 1 minute chart, and you guys can see this is post earnings. So after what happened when earnings was released. So we can see right now it's been pretty flat. It's done basically nothing. It's closed around 181, and right now it's trading at 176. So a $4 drop on the stock. The expected move for GameStop, which was crazy, if we go over to all products here on Thinkorswim and you type in GME, this yellow box or this yellow text right here is the expected move on the stock. It was $55.13. That means that after earnings, GameStop had to go up to over $235 roughly for call options to appreciate, or it had to go down all the way to $135 roughly for put options to appreciate. That is a very, very large spread. That's about $100 up or down that the market makers were giving GameStop for the expected move. So even if GameStop moved within this $100 range after earnings, calls would depreciate and puts would depreciate, totally killing the implied volatility of these contracts. This is extremely important to know because even if you had a $200 call on GameStop and the stock went to $210, tomorrow you would wake up and your call options would be down in value. Now, this is true all the way until market open tomorrow, and it's also very true on which contract you choose. But if you choose a March 26th, which is Friday this week, expiration, and the stock opens up tomorrow flat at just around $170, then both calls and puts will be completely wiped out by implied volatility. The way you take advantage of this very large spread here that we have mapped out, this $100 wide spread, is with Iron Condors. This is a play that if you take this trade, you're basically saying, I'm agreeing with the market makers. I want to take the trade that they already sort of have in place, and I want to agree with them and say, okay, I think GameStop is going to stay within this $100 range, and let's go ahead and make some money on this expectation. So when you set up this trade, which we'll do in a second, you set up the trade saying that you want to have GameStop stay between the expected move. If you wanted to do a trade where you wanted GameStop to move outside of that expected move, that would be a straddle or a strangle. So let's go ahead and cover the Iron Condor first. So I'm going to pull up, and we can see right now that GameStop's starting to fall here after hours. It's probably due to the earnings call that just started. So let's go ahead and pull up my E-Trade account. So pulling up the E-Trade account where we can go over this Iron Condor, let's go ahead and just quickly run through this. So if you're not familiar with Iron Condors, it's basically two spreads that are set up. So You have a put side spread and you have a call side spread. You're selling a put and you're buying a put as protection. You're selling a call and you're buying a call as protection. So let's go ahead and look at the put side first. So you're selling the 140 put, you're buying the 135, meaning if you sell a 140 put, you want it to stay above 140 because if it expires out of the money, then you get to keep your premium, right? So you're selling a 140 put and you're buying the 135 just in case it drops below. The reason you buy that 135 is protection, because if you just sold the 140 put, it'd be a naked put that you're selling, which is extremely risky. And if you don't have the cash to cover it, then you can be in a really sticky situation. So the first side here of the Iron Condor is the put side, where you're selling a 140 and you're buying, or it could be any strike, and you're buying a put a little bit lower out of the money. So a 135 and a 140. You can choose how wide you do it, the strikes that you choose. That's going to obviously influence the amount of money that you can make or the amount of money that you can lose. So the wider it is, the more riskier it is. So right now we have about a $5 strike spread here on these puts. The other side is the call side. So you're selling a 230 call and you're buying the 235. So still a $5 spread, which is the same here. It's just you can see the strikes go from increasing by 1 to increasing by 5. So on the call side, you're selling this 230 call and you're buying the 235 as protection. So you want the stock to stay below 230 and you want the stock to stay above 140. So you want it to go anywhere in between this range of all these strikes that you see right here. I'm going to go ahead and move this so we can see this a little bit better. So you want the stock to stay in between this range. How I picked those numbers: first, I did 50 plus 180, which is about 230. It's a pretty rough estimate, right? And then on the other side, I did a $40 decrease from the in the money, which is about 140. So the reason I did that was because I looked at these contracts and I found this to be the best risk reward: selling the 140, buying the 135 put, and selling the 230 and buying the 235 call. This is an Iron Condor. You can basically see how you have a spread within your contracts, and you can see that you want it to stay in between those numbers. Can't really get it all on the screen. I'll go ahead and make this smaller so maybe we can see that. So right there. So that's a little easier to see. Any strike price in between these two cells, you will make money. The amount you'll make is right here. So you can see the max profit is $322 and the max loss is $178. So you have about a 1.8 to 1 risk reward ratio, which is pretty good on a trade. You also have the curve here and you can see how much you'll make depending on the price of the stock. So right here at expiration, if the stock is above 136, you will make your money. And then if the stock is above around 233, 234, you will make your money. So right here is where you want the stock to stay, and that's that range right there is your range of the expected move. So that was a cool trade, right? You have a 2-to-1 risk reward ratio basically. You have a max downside of $178, and the probability of this happening is extremely high. Right now, it is holding true. You would be profitable on this Iron Condor if GameStop stays between this range. And on the chart, you can see I have these lines set up. So you could, if you want to have it stay above 135 and you want to have it stay below 234. So here's an Iron Condor. It's a cool example. It's a potential trade that you guys can look into if you want to learn more about selling contracts, selling spreads, taking advantage of theta, taking advantage of implied volatility. It's a pretty cool trade. Now, the reason why this Iron Condor is working so well is because the implied volatility on GameStop is so high, which is causing the option premiums to be very high. And the expected move was $50 a share, a $100 range, which is about a little bit over, just about 30% of the stock price was how much the stock was expected to move. It was expected to move over 30% to either the upside or downside, and the implied volatility was so high, so the premiums were very, very juicy. So if you sold these premiums, you could make a lot of money, and the stock had to move so much. And that's sort of why this Iron Condor was such a good setup. Now, another thing that you could have done if you own 100 shares of GameStop, let's say you owned 100 shares of GameStop back towards the bottom, let's say $40 or $50, you could be selling covered calls all day, every day if you really wanted to. You could be selling these $300 calls, these $350 calls, this $400 calls that are so ridiculously out of the money, which have a very small probability of actually becoming in the money. And you could be making money selling these all day. So if you had 100 shares at 50, you could sell this $300 call for about $680. and you can make $680 by this Friday if the stock stays below 300, and you can rinse and repeat this all day. So let's say you had 1,000 shares. Let's say you went pretty big. You could sell 10 of these. You can make $6,800 by this Friday by selling this $300 call. And the worst thing that happens is you have to sell your 1,000 shares at $300 a share, which is most likely a good return still if you have 100 shares or 1,000 shares down at the lows. So that is another way you could take advantage of these high implied volatility, is if you own shares on GameStop and these call options are so juiced up and the premiums are so high that selling call options could be a great way to make some money. You could sell the $400 calls for $320. You could go all the way out to $690s and still make $145 by selling the $690 calls. If you don't think GameStop is going to hit $690 by this Friday, which I would assume it's not, then you could go ahead and sell this call. So some pretty interesting stuff. A good, it's important to know these premium selling strategies, these Iron Condors, selling calls, selling cash or cash secured puts, and selling covered calls. Very important to know. Hopefully you guys enjoyed this one. So that's going to wrap it up for today's video. If you're interested in more of these theta gang type strategies, selling calls, selling puts, some of these spread type strategies, make sure to let me know down in the comments below. I'd love to start covering them a little bit more, especially with a market that's been chopping around sideways. This is potentially a great time to learn these types of strategies. So if you enjoyed it, make sure to smash that like button for me. Subscribe to the channel for some future videos. Make sure to press that bell notification, and I hope to see you in the next video. Peace.